morning and then good evening, everyone. My name is Dilek Tekdemir. I am the research manager at EPRA. Welcome to our third and the last research webinar series dedicated to 2023 academic research papers. Today we have Yu-Cheng, Lin, Robbie, and then the Jufri Marzuki from Western Sydney University. They will present their results on the paper titled Interest Rate Sensitivity of Different Real Estate Sectors, Evidence from Global Listed Real Estate. And then we will discuss all the highlights of the research. The full paper of this research also available on our website. You can download the full paper of this research and also other two research papers from the QR code you are seeing in the screen right now. Also, you can see, you can also visit our website to download the full papers. Before give the floor to Robbie, I want to share with you some questions we already asked you when the interest rate cut will start. Or the sector performances during the interest rate hike or the cut period. Today, we will have just a chance to discuss all the details. And also a kind reminder to you, if you have any queries, please put on the chat, and then there will be a debate moderated by Alex Moss, our research committee chair, and then we will discuss all the details. Now, I am giving the floor to Robbie. Robbie, the floor is yours. Thank you.
Thanks. Thank you, Dilek. Thanks for introducing me. So I'm more than happy to present my research project titled Very Interest Rate Sensitivity of Different Real Estate Sectors, and with global listed real estate evidence, and co-authoring with Jufri Marzuki, lecturing in property at Western Sydney U. And today, my presentation will follow the content to introduce the conceptual framework of the research project and the multiple types of institutional CRE investors who are expected to benefit most from interest rate risk management strategies and TAA portfolio construction strategies conducted from this project, as well as data proxy use and its time frame, and followed by the background of interest rate cycles across the States, UK, and Eurozone. And the core analysis will be split into two key research themes and their respective investment strategies for different types of institutional CRE investors in global equity and credit markets. And the first thing, use a Gaussian model to assess quantitative interest rate sensitivity of LRE and its subsector in the period between January 2006 and December 2022. And the analysis offers debt investment strategies and the impact of US monetary policy on LRE and its subsector for conventional and alternative CRE lenders to identify where loans are at a greater risk and to ensure margins are sufficient to compensate for the high volatile investment risks in terms of the scale of interest rate increases and the depth of yield curve inversion in global capital market. The analysis also offers distressed asset investment strategies for buy-side and sell-side asset managers to identify and to pitch non-performing assets across sectors and across markets in stock pitching and due diligence processes. And the second thing, use a downside risk portfolio to reflect high volatile investment risks in rate hike cycles. And the analysis offers TAA portfolio construction strategy for each real estate sector in both rate hike and rate cut cycles across the three jurisdictions. And the buy-side asset manager are expected to benefit most from the analysis for allocating their capital to each real estate sectors in rate hike and rate cut cycles, as well as active and passive investment strategies. And the sub-period analysis will cover in the analysis and will quantitatively measure by the peak and through analysis, including 3 rate hike cycles and the other 3 rate cut cycles. As you can see from the left graph, so the green bars stand for the rate cut cycles, while the red bars stand for the rate hike cycles. And the rate hike cycles will follow by economic recessions, including GFC in 2009 and the COVID in early 2022, which will further follow by the rate cut cycles, including the period after the dot-com bubble in 2000 and after the GFC in 2009 and after the COVID-19. And in the recent rate hike cycle, the Federal Reserve has increased the fund rate by 525 basis points, and which is the fastest in the last 35 years, and hike the rate in 40 months. Meanwhile, COE and ECB have increased their fund rate by 500 basis points and 450 basis points respectively. And in the period between 2015 and 19 was relatively stabilized in Eurozone, unlike the rate hike in the States and the UK. So Eurozone will be discussed separately from the States and UK in the following analysis. And driven by global rate high cycles, the cap rate for each real estate sector increased sharply during the period, and which have caused devaluation across real estate sectors across the three jurisdictions, particularly for office and retail. And however, industrial in the States, resi across the three markets headed to the opposite direction, but it highlighted the need to assess interest rate risk management strategies and TAA portfolio construction strategies across the three markets at the sector level. So the first thing is designed to assess quantitative interest rate sensitivity of each real estate sectors to 3-month T-bills, 10-year government bonds, and the 10-year, 2-year spread across the three jurisdictions. And distressed asset investment strategies and debt investment strategies will formulated from the analysis, and particularly 10-year and 2-year spread has been denoted as the leading indicator to forecast economic risks by the Federal Reserve of San Francisco compared with the 10-year and 3-month spread. So this highlights the use of 10-year and 2-year spread in the analysis. And in terms of sensitivity to 3-month T-bills, diversified retail and self-storage were the most sensitive sector to the 3-month T-bills across the three jurisdictions. However, industrial was less sensitive sector to the short-term interest rate across the three markets. In terms of the sensitivity to 10-year government bonds, industrial, self-storage, and resi were the most sensitive sector to 10-year government bonds across the three jurisdictions. However, healthcare was less sensitive sector to the long-term interest rate across the three markets, particularly healthcare in the States equip empirical interest rate hedging abilities against 10-year government bonds. And in terms of the sensitivity to 10-year and 2-year spread, diversified office and resi were the most sensitive sector to 10-year and 2-year spread, which implied that these three sectors was the most vulnerable sector in the economy recessions. And distressed asset investment strategies were therefore formulated from the analysis. So self-storage, resi, diversified, and retail was estimated as cyclical real asset to interest rate cycles, aligning with APEC and US results in my early study in 2021 and 2022. And however, on the other hand, these four sectors may benefit the most and could potentially be the quite outperformer when interest rate cuts that market expect in the second half of this year. And office, diversified, and resi were the most sensitive sector to 10-year and 2-year spread, indicating that these three sectors was the most vulnerable sector to economy recession risks. And on the other hand, these three sectors may benefit most from economy recovery across the three jurisdictions. Business park lodging was tasked as defensive real asset to both economy recessions and interest rate cycles, as well as healthcare. But healthcare result was divergent across the States and the UK. Healthcare in the States equipped empirical interest rate hedging abilities to 10-year government bonds and 10-year and 2-year spread. However, healthcare in the UK was vulnerable to 3-month T-bills. And strong interest rate hedging capabilities of industrial and of business park and the healthcare may be attributed to their fundamental driver, boost last by economic growth, but more on the growth of demography, healthcare, and technologies. That investment strategy was also formulated from the analysis in the first thing, even though the LTV ratio proxies are only available in developed Europe. So LTV ratio was expectedly negative to mainstream subsectors, including diversified office and retail. It may attribute to their relatively high level of LTV ratios. And on the other hand, LTV was unexpectedly positive to industrial, self-storage, and resi, indicating these three sectors delivering higher total returns boosted by their higher leverage. And this may attribute to relatively low level of their LTV ratios. And the second theme is designed to assess portfolio weighting for each real estate sector in mixed asset portfolios across the three jurisdictions in rate hike and rate cut cycles. And TAA portfolio construction strategies, as well as active passive investment strategies, were therefore formulated from the analysis in the second theme. And from the slide, as we can see, the addition of composite LRE made no difference from the baseline portfolio, which constitutes stocks and bonds only across the States and the UK. And this also aligns with the current market trend of difficulty in capital raising in recent global CRE markets. However, if we take a closer look at the addition of each real estate sector, so we can see across the States and UK, industrial was the best performer, providing the highest portfolio return enhancement capability compared with the other subsectors. And in the UK, industrial was followed by self-storage and healthcare. And as we discussed earlier, the Eurozone result will be separately from the States and the UK because in the period between 2015 and 19, Eurozone was relatively stabilized, unlike the rate hike in the States and the UK. But the Eurozone results showed a similar pattern to the States and UK. Industrial, in the stabilization period, industrial was still the best performer and providing the highest portfolio return enhancement capabilities. And it was followed by diversified resi and office sectors. And the following slide, we will introduce TAA portfolio construction strategies in rate hike and rate cut cycle respectively, and introducing their respective investment strategies. And so from the slide, we can see the black bar stand for the bonds, the orange bar stand for stocks. So if subsector was weighted, their respective color in the respective jurisdiction will stand out. So we take recent rate high cycles between March 22 to December 22, for example. So each real estate sector was basically unweighted in mixed asset portfolios across the three jurisdictions. And in the previous rate high cycle between 2015 and 2019, we can see industrial was weighted the most across the three jurisdictions and followed by resi, self-storage, and healthcare. So TAA portfolio construction strategies in rate hikes was formulated from the analysis. So industrial was weighted the most and was the most resilient sector in the rate high cycles and was weighted over 50% in the States, UK, and the Eurozone. And resi was ranking the second best and was weighted 50% in Eurozone, 37% in the States, and was only limited 8% in the UK. And this might align with the results in the first thing that resi was estimated as cyclical real asset to interest rate cycles. And healthcare was weighted 46% in the UK and only 10% in the States. And this is despite that healthcare equipped empirical interest rate hedging abilities to 10-year government bond and 10-year and 2-year spread in the States. Self-storage was weighted 48% in the UK and was limited only 10% in the States. This also aligned with the result in the first thing that self-storage was estimated as cyclical real asset to interest rate cycles. Office and retail were unweighted across the 3 jurisdictions. The only exception was office in Eurozone, and which was weighted by 53% in the Eurozone portfolio. And let us go for the rate cut cycle. And following the same pattern, we can see the 2 rate cut cycles show divergent results, including the period after the GFC and the period after COVID-19, where stimulus plans was widely deployed by global central banks. So after the GFC, self-storage was weighted the most, followed by the healthcare. And after COVID, industrial replaced self-storage as the best performer and was followed by self-storage, resi, and healthcare. Specifically, after GFC, office was weighted 56% in the UK and resi was weighted 44% in the States. Resi, retail and industrial was weighted by 58% and 56% in the Eurozone portfolio respectively. And after COVID, resi and healthcare was weighted by 28% and 23% in the UK portfolio respectively. And unfortunately, industrial and resi were basically unweighted in the Eurozone portfolio. This may attribute to that industrial in the Eurozone was suffer from the structural change during COVID-19. And as for active and passive investment strategies, we can feel that diversify was barely discussed in the second theme analysis. This is because their portfolio weightings was relatively lower than sector-specific real estate sectors, including office, self-storage, healthcare, resi, and industrial sector. So this also suggests that institutional CRE investors should actively make their own sectoral investment strategies and decision-making by investing in sector-specific real estate sectors rather than passively rely on a diversified portfolios with multiple real estate sectors. And this is the end for my presentation, and we are welcome for your questions.
Great. Well, thank you very much indeed for that, Robbie. And a reminder to people, please put any questions you may have in the Q&A or the chat. I've got a few just to kick off with. And my first one is that's very interesting in terms of the cycle historically, Robbie. But what would you say are the implications for equity investors in 2024, where we're clearly at a stage where across all 3 jurisdictions, everybody is hoping for, broadly speaking, rate cuts sooner rather than later, and there's a debate over the quantum. What would you say that the implications are for your research for equity investors from here on 24 and going forward?
For equity investors, I mean, from our analysis, we showed that the TA portfolio construction strategies across both rate hike and rate cut cycles. And in my view is, I mean, even that the market expects that, I mean, the Federal Reserve and Global Central Bank will cut the rate at the second half of this year. But imagine that FOMC only have 4 meetings in the second half of this year. And if they cut the interest rate 3 times, I mean, the fund rate is still above 4.5% or over 4%. So under these circumstances, our TA portfolio strategies in rate hike cycles identify that lodging and business park and healthcare was estimated as defensive real asset to interest rate cycle. And if we see more interest rate cuts or interest rate cuts sharply, and it may happen while the economy recession approach to us. So in the rate cut TA portfolio strategies, we also identified that self-storage, resi, retail, and can benefit most in the rate cut cycles.
Great, thank you for that. And we've got an excellent question here from Alex Skiranis about central bank policy. And his question is as follows. In the after GFC period, clearly no conventional monetary policy was used. There's sort of global QE. And he's saying that your results from the Garch analysis take that whole sort of 2006 to 2022 period into consideration. Even though there's no conventional monetary policy there, how do you account for QE within that, or any other forms of, if you like, unconventional monetary policy? Because I remember on that chart, there's that long period where you can see there's a 10, 11 years and the impact of QE. So I think it was probably one of the first charts. There we go, that's the one. So his question is, from that 2006 to 2022 period, you've taken the whole period. Do you account for QE because it's unconventional, or any other forms of unconventional monetary policy in this? Or indeed, is it possible to account for it?
Obviously, it is possible to account for it. And for our TA portfolio strategy was actually conducted by superior analysis. And for interest rate sensitivity analysis, we are happy to conduct superior analysis. And in my early research, we actually conducted superior analysis, and the results basically align with the results of our EPRA project.
Great, thank you for that. And following on from my first one, you talked about equity investors. It's very interesting here that you've taken into account as well credit strategies for investors. Does it differ in terms of the outlook for sort of debt investors from 2024 onwards from the equity side, or is it broadly similar?
I think it's both basically similar from our research analysis. And for both equity and debt investors, distressed asset investment strategy may be one of the good strategies to take on. And we also identify distressed asset investment strategy to identify, where loans are at a greater risk and which real estate sector was more sensitive to different interest rate proxies. So that is basically over institutional investors or alternative CRE lenders, a better understanding on the sensitivity and advantage of each real estate sector in different periods.
Great. And actually, my other question is really just going back to what you were talking about in terms of the sort of tactical asset allocations, in terms of the weightings, etc. That presumably was done on a sort of an unconstrained basis, was it? Because you had some fairly high percentages there. Is the next phase of the research to sort of look at constraints on that? Because obviously in practice, people might have a constraint on that.
Yeah. So for our research is simply providing a clear picture of the portfolio weighting of each real estate sectors in different interest rate cycles. But practically, we understand that institutional investors typically only allocate 5 to 10% in real estate. So we are more than happy to conduct the constraint portfolio analysis, and also take some example like a pension fund. They may have their own preference on mixed risk and return spectrum. And so we are more than happy to assess the portfolio weighting strategies doing their preferred risk return spectrum. But further research will need to be discussed and conducted. And we are hoping that we will inform institutional investors going forward.
Alex, just to add to the 10% allocation. So probably future research will also include other vehicles in property. So we will consider the use of non-listed funds as well as direct investment in property, just to make sure that we reflect the actual allocation in real estate for institutional investors.
Got it.
And more color from that is that we are more than happy to collaborate with EPRA going forward in the future research project.
Absolutely. And one question, a final sort of question I have, and say people please put your questions into the chat. You've split it up into very clearly sort of up and down cycles, sort of cut and hike cycles, and you've clearly based it all effectively. It's predominantly driven by the Fed. the sort of reaction to those. One question I have is how would you say, what strategy would you recommend for people in a sort of a varying cycle? Because clearly sometimes, as you can see from that chart, you have a period of variation where it's up and down within the same period. It's not clearly defined as a long-term hike or long-term cut cycle. What would you recommend? Final question, what would you recommend as a strategy in a sort of a varying interest rate cycle?
So under this confidence, I understand that monetary policy across global central banks are quite customized and may vary from one another. Like China currently, they cut the interest rate and employ the stimulus plans, and that is quite different from major market. So under this confidence, I would suggest that individual market will need to be conducted. And particularly for Japan, which have utilized their yield curve strategies for the past 30 years. So individual market research and analysis will further be diagnosed. But I mean, again, it's that the results from our EPRA project conducting the analysis for the States, UK, and the Eurozone was generally aligned with Asia Pacific and US results that I conducted in the early studies in 2021 and 2022. So I thought that for the results from our research project is quite useful. And I mean, at a base point is that offering the baseline results for institutional investors.
Got it. And a final question, actually. You showed a very interesting slide where you had all the three regions and you showed the decline or in some cases increase in value of that's it. That's the one. Fabulous. Who doesn't love an infographic? I guess my question on that, what was that based on? Is that based on the underlying NAVs or is that based on a direct index or what's that based on?
It's based on underlying real estate as value growth by MSCI that we get the information from data stream.
Got it. And what's very interesting about that is obviously the high level of consistency there across the region. So offices pretty much a sort of a -8% across the board with retail down and industrial and residential up across all of them. Excellent. Okay. Well, I'm conscious of time and I think we're sort of pretty much running to the end of our time. If anybody has a final question, this is your final chance to let us know. But otherwise, I'd like to say thank you very much, Robbie and Jufri, for a fabulous presentation. Very interesting about the different periods of the cycle and clearly a very hot topic for people for 24 and going into sort of 25 and 26. And look forward to future updates of this research. Thank you very much.
Thank you, guys.
Bye now.
Bye.